Welcome everybody to PKF Francis Clark's Navigating the Business Journey, Exit Options, Managing Risk and Protecting Assets. I'm Giles Hutchins. I'm going to be your host for today, chairing us along, trying to take us through the 60-minute session. So we're going to have probably 50 minutes on the subjects, and then I'll talk you through the Q&A session in a minute. I just want to introduce the sort of people that are going to help me with this session today. I've got Ryan Pring, who's a partner in our BA business advisory team. He's a succession specialist. I've got Matt Garnett and Kevin Stoyle, who work in our financial planning business. So they're chartered financial planners who help our clients on all their wealth management needs. So as I said, we're going to take you through the session, 60 minutes. We're going to have a Q&A session. So you'll see within the session, you can enter a question and answer on the right hand side. So please enter those in. What I'm going to do is I'm going to have probably 10-15 minutes at the end of questions and answers, but also I'd like to take a load of questions during the session as well. So please enter the questions in there. So what we're going to do today is we're going to take you through what we call the business journey. So we as general practitioners work with our clients to take them through the end-to-end journey. So start up to business to end, and when they may exit in whatever form that may take, and then trying to take you through that journey from start to end, and also trying to help you to understand how you might motivate staff, how you may incentivize people, how you may manage risk, protect assets, manage cash. So we're going to take you through that journey. So what I wanted to kick off with is trying to get a general overview from everybody on the panel around what we're seeing within our client bases and what the challenges we're facing. So Ryan, I just wanted to sort of understand from you what you're seeing at the moment.
Yeah, sure. Hi, everyone. Apologies in advance. Took a few days off last week, caught a cold from my eldest, so struggling a bit with the throat, but I'll try and hold it together for the hour. Just useful, perhaps, just to for everyone to get a feel of the clients that I'm working with at the moment. So my portfolio is made up of primarily owner-managed businesses. So those that are shareholders, proprietors, but also involved with the day-to-day running of the business. The bulk of those are family businesses, so husband and wife, typically, or siblings, etc. And lots of those now are into kind of second generation of ownership. Did a fair bit of auditing in the past, but most of my clients are now under the audit threshold. I've got several that have just tipped over into audits, but primarily, turnover of 50,000 up to about 10 million. So quite a broad range of clients, but hopefully gives you a bit of sort of sets the scene really with regards to sort of common themes that are coming out with those clients. So yeah, just made a few notes really in terms of risks. I guess it's something Kevin and I were talking about fairly recently. Is the number or the level of borrowing within clients, particularly more established businesses that have perhaps post-COVID increased their borrowing through necessity, obviously. And I think there's probably been little thought to the overall repayment of that, even less thought to perhaps if there's a loss of a key employee, or there's been some critical illness within the management team, how those kind of repayment commitments are going to be met in the event of something like that happens. So I think that's a key trend at the moment, and something that starts to come out of the woodwork post-COVID. I think, again, going back to something I said earlier, second generation, generally siblings in business together. I think a lot of people are starting to think sort of a succession piece here, really, but in terms of risk to the business, it's where those shares go in the future. I think I've got a case which I'll probably touch on a bit later, but where there's two siblings, two brothers. One of them has been quite poorly, and there's been conversations really. Thankfully, he's okay now, but really, what would have happened in the event of him not recovering? What would happen to his shares? The actual would have ended up passing to his kids, which wouldn't have been very good for the business generally, particularly for the surviving sibling. Wouldn't have wanted to be in business with his nieces and nephews. So there's a big piece now that we're doing with them. So I think that certainly is something we've been noticing a bit more of. Succession, I guess, what's the biggest thing I think is, I was talking to Charles about this earlier, is I don't think kids necessarily want to be following in parents' footsteps to enter the family business. I think that's always been seen historically as a kind of a natural a natural route to pass it down to children, but I'm seeing less of that. And I think what that's doing is it's just making those succession conversations more relevant, because one of those options is essentially kind of been taken away. So we now look at different things. So that's definitely up there. And I think, again, just generally, it's more of a trend really than a kind of risk. But I think trend-wise, people generally seem to be talking about succession, their end game, their exit strategy a bit sooner, a bit earlier. Again, I'm not sure if that's because we're asking more questions or whether it's them bringing that to the table themselves. But I think it's probably more the latter, particularly post-COVID. People trying to weigh up what they want in life, which the clients I'm dealing with is very much business and life very much intertwined. So when they're weighing up what they want to achieve going forward, often that revolves around what they want to do with their business. So yeah, just more of a trend than anything else, Giles, but hopefully just a useful taster.
Yeah, no, it's interesting what you say there, Ryan, about people looking to exit earlier. I think we've definitely seen that with our client bases. Post COVID, I think people have really reflected and trying to thought what's actually important to them, and actually maybe time is an important critical point. So I think that's become very, very prevalent, where we've got clients that have never really talked about exit, and they go to knock on the door, and actually they are open for a sale. So definitely seeing a lot more of that. Matt, I just wanted to get a kind of flavour from kind of your client base, but before, we've had a kind of question in really, which will link to you. So I thought I'd bring it now.
Sure.
Obviously Ryan's talked about increases in cost and within the business, but one thing that we've seen as well is lots of businesses holding lots of cash as well, and obviously now with interest rates being high, obviously there's quite a lot of talk around how people manage their cash and cash management. So just wanted to kind of get a flavour of whether you're seeing a bit more of that before you tell us what you're seeing within your client base and what people should be looking for.
Yeah, absolutely. I think certainly over the last 18 months or so, interest rates have been a lot more favourable for clients, particularly those who are looking for something a bit more short term. So perhaps if you're planning projects in the next year or two, or you maybe don't want to be investing that money because volatility in markets. So absolutely, we're seeing more and more interest in what cash rates are available out there. And I would recommend anybody just to do your research. There's plenty of providers out there who are offering reasonable interest rates. Those rates do seem to be coming down a little bit, but there is still some good returns to be had, and it's secure. It's in many cases easily accessible, perhaps with a slight penalty of interest, but if you're funding a project, that's a side point really. So no, we are certainly seeing a lot more of that, and there's definitely returns to be had. I think the COVID point that you raised sort of ties into that nicely. That was the one thing that I'd written down on my notes. Attitudes have certainly changed. People are thinking a lot more about exit planning and what that sort of looks like. Certainly on an insurance point of view, it's focused a lot more minds. There's plenty of clients that we know who have sadly lost people or have had colleagues or family members who fell very, very ill through that period. So there's been a lot more focused minds, I would think, and particularly around, well, what does the end kind of look like? A lot of people have always just sort of assumed that they would sell their business at the end, but never really put a date on it or thought about when that's likely to happen. So we're certainly seeing a lot more conversations. Well, how can we help move towards that sort of exit plan?
Matt, are you seeing that?
Yeah.
Are you seeing? Sorry, mate, but are you seeing that earlier? Are you seeing people asking the question earlier around planning for the long term? So the long term plan, because you take yourself back to when you were a kid and somebody tried to sell you something when you were 18. I think I'm definitely seeing that, and obviously you're seeing that as well. People planning earlier.
Oh, absolutely. I think a lot of people have sort of seen their business as their life. We've got plenty of clients. You and I work very closely together in Plymouth, where if you ask people what do you do in your spare time, they say, well, I run the business. And perhaps COVID has focused them on a little bit more to think, well, actually, there's more to life than that, and what does that exit kind of look like? And I know a frustration we've all had in the past is trying to get into these conversations as early as possible, and clients maybe weren't quite as open to talk about what exit looked like. But certainly I think COVID has changed mindsets dramatically, and a lot more people are looking at, well, what options are there for me? So no, absolutely. I mean, the other big thing that we are talking a lot to clients about at the moment is tax planning. Particularly we're in an election year, so things may well be changing, but people seem to be very aware of the tax they're paying now. And certainly for us working alongside you guys in the accountancy practice, it goes hand in hand. It's a fantastic opportunity for us to really help clients in multiple areas, but certainly tax planning seems to be a big one that we're seeing a lot of.
I think what you'll find, Matt, is that in where we are at the moment with budget coming up next week and an election this year, people are always focus their attention much more around tax rates. So I think Ryan and I are probably seeing a lot more people talking about exit and securing capital gains tax rates at low rates, because there's a lot of talk that income tax, rates, rates on capital gains tax might align with income tax. So I think that's probably what we're seeing. So sort of coming to you, Kev, before get your views. I just wanted to have a question as well. Is are you seeing in your client base, Kev, that there are a lot more people that probably are looking to have less cash in retirement? So balancing that, getting out earlier with actually, how much cash do I actually really need to live on?
Yeah, and I think I work very closely with Ryan in Torquay. We've got a number of clients who, as you've all alluded to before, COVID has brought things forward. So I speak to Ryan regularly and to our mutual clients about starting that financial plan as early as possible to give you that option of retiring at 55 as opposed to 60, and creating that financial independence from the business, so you can choose the time scale that you choose to retire. I think we do hear sort of horror stories of people selling their business at 60, 65, and they were to pass away maybe a couple of years later and leave a sort of a bucket list of things that they wanted to do. So people are seeing a lot more of that actually when they're in good health, and if they've got the money there available to do it, they want to go on these, sell the business, go on holidays, help the kids, the grandkids, and actually it becomes more of a quality of life, and as best they can, which is why Ryan and I tried to start those conversations about locking in profit, thinking about your timescales and how much you need when you do actually walk away from the business, and getting that focus as early as possible, so you've got a goal to work towards over the years.
Kev, are you seeing, before you kind of see what you're seeing in your client base, are you seeing a lot more people doing what I call cash flow modelling? So I know you guys are doing a lot of modelling around, but blending in, different flexing things to say, what would interest rates be? What if I died at 85? How much do I need in my retirement from 60? Are you seeing a lot more of that? Because I'm certainly seeing a lot more of that.
Yeah, and certainly, I was talking to a client last week, and we're just putting a proposal to him this week, where he's got a very successful business, and he's never really thought about how much do I need in retirement, how much to him and his wife need to have the lifestyle that they want. So we're saying, well, actually, you've got this time scale of 5-10 years, and we can assume you're going to use your pension allowances, your ISA allowances, and then using certain growth assumptions and life expectancy assumptions, we can say, well, actually, you can retire at 58, and based on this, you can afford to do it. And that's finding that clients are comforted by that, and that's a movable feast. It can change as the years go by, but it gives them the confidence and the reassurance that they're on target for what they want, and cash flow is a key part of that.
Yeah. So just to finish off, Kev, what kind of opportunities and challenges are you seeing within your client base, wider than what perhaps Matt and Ryan have seen? Is there anything else you wanted to kind of add?
Challenges. I think there's lack of confidence sometimes in markets. I think investment returns haven't been good over the course of the last couple of years because of the war in Ukraine and the cost of living. So having money in cash at a couple of percent is quite appealing when they see markets fall. Matt and I both know that investment's a long-term thing, and investments have outperformed cash and inflation over longer term. So getting clients to put money into the market can be a bit of a challenge at the moment. Again, protecting the business, something happening always happens to somebody else, and if they don't plan for something happening, then it's normally too late by the time it does. So those are the general issues I've had at the moment. I don't know whether Matt's in similar, but with the markets hopefully picking up and interest rates falling, inflation falling over the course of the next year or so, hopefully that should turn the tide back to sort of longer term investment planning as a key part of the business planning and succession.
No, thanks for that. Guys, have you got anything else to add before we kind of move on swiftly?
I just a comment really. I think it sort of penny dropped when Matt was speaking there, really, in terms of, I think in the past just on the succession piece around businesses, often when you speak to someone about the exit of their business, I think it's been linked intrinsically with their mortality. I think, and they feel like you're having a conversation around death almost. And I think actually COVID has separated that. And yes, that leads to the retirement and going on. But I think people are much more open to having conversations around the exit of their business, and that will allow them to fulfill retirement, and then we'll deal with IHT and mortality conversation further down the line. So I think there's been a separation perhaps of that business and mortality piece. And it was just a question really for Kev. I know it's slightly off topic, but in terms of opportunities, well, and Matt as well, but trends, as I'm always interested in looking at trends and things in terms of the way the use of pensions and things. I mean, obviously that's gone. People are with cash being in companies. We've seen a lot of, particularly from our side, Giles, we've seen a lot of people using their pension pots to kind of safeguard assets in the future. Is that something that's across the patch? I know I'm leading you a little bit, Kev, but Matt, I assume there's something you've seen in Plymouth just as much as we have in Torquay.
Yeah, do you want to jump in, Kev? Do you want to?
Ryan set me up a little bit there,
yeah,
but no, yeah, and I think pensions are obviously very attractive from a tax planning point of view anyway. Me and Ryan have had multiple conversations with multiple clients about the benefits of that. So locking in and securing the corporation tax relief, securing the inheritance tax relief, that all comes with pensions. It is a lot easier to explain the benefits and the fundamental importance of a pension plan within an exit or a retirement or whatever plan they're coming up to, irrespective of how they leave the business. It's an asset of theirs which they can use in retirement, and if they don't, the current rules are subject to government changes. The current rules are that it can be used by a surviving spouse or children if they don't use it during their lifetime. So it's a very important and flexible tool for anybody who's looking to build up assets outside of the business before they retire.
I think just to add to that point, because Kev's absolutely bang on, that's absolutely the cornerstone of all of our planning. Is the first thing we will discuss with clients is pensions. But pensions, investments, etc., for some people have a bad reputation, and I think it's important for people to understand that a pension or an ISA or whatever, this is just a wrapper that goes around the outside of an investment. So if you have a client who is particularly risk adverse, there's nothing wrong with saying you can't invest into cash within your pension. So it doesn't always have to be risky, but you can still lock in those tax benefits that Kev was talking about. So it's really important for us that clients understand that we want to use all the tools available to us, particularly this time of year, because we've only got a month or so, and then these allowances are gone. So it's really important that if clients are to move, they move quickly.
It's a great quick point, that, Matt. I'm just thinking you can tell the change in attitude a little bit with regards to pensions, because I agree they've given a bit of a bad rep in the past. But I'm speaking to a lot of construction companies, and they're becoming more interested in pensions, whereas previously they are very much bricks and mortar. They want to be able to touch the asset going forward. They don't want it today. But they're now looking at how we put it into that wrapper, as you say, and then we use that wrapper to go and buy bricks and mortar, and that's stuff they understand. And we've had this multiple times, haven't we, with construction? Whereas previously, if you mentioned pensions to them, they would have quickly shut that conversation down. So I think that's just an evolution of perhaps how attractive pensions have become over the last 5 or so years, I guess.
And I think Ryan, you've covered off the point I was just about to cover off. But a lot of clients who don't necessarily believe in investments, they don't understand the stock market or whatever, want to do something more than cash. If they've got the resource to buy their own trading premises, that is something that we do a lot of. That is very tax efficient. So it allows the company to pay rent from their business into their own pension and get further tax relief, in addition to the annual allowance that everybody has. So we went through a stage of doing quite a few of those, because the tax advantages of holding the property normally outweigh holding it personally or potentially in the company. And so that's the work that we've done a lot of, I know, fairly recently.
Yeah, no, thanks, guys. And that I think that was a really useful summary of kind of what we're seeing in the markets and what we're seeing with our clients. Just wanted to remind everybody about Q&A session. Please, enter your questions in the right-hand box on your screens. Great to have a few more questions. We've got a few come in. It'd be great to have a load more, just to challenge the guys and really put them on the spot. Love to see them sweating a bit more than they are. Just a few things that I picked up really from those things is, the critical bit here is providing bespoke and independent solutions to businesses and clients, really. Not one size fits all with every client. It's about listening, understanding, and finding the right bespoke solutions. And the other thing, Ryan, that I picked up from what you said about succession, and definitely what I'm seeing, and I think probably what a lot of our family business specialists are seeing, is those succession discussions are less emotional than they used to be. There used to be very difficult, emotional conversations where you had lots of family members in a room getting very emotional. I think people are getting much more practical and sensible around exit and planning. So certainly seeing planning earlier and in a calmer, more constructive way. So that's kind of what I'm seeing. And one thing I wanted to do before we took us on that journey of succession options was really kind of paint a picture for you. So I've got a business. It's run by brother and sister, and they're on that business journey and they're kind of merrily going along, both of them married. And one thing that I think we miss quite a lot, Matt, is really around, the what if one of them died suddenly, who owns the shares, but actually how do we protect against those shares and their other halves potentially coming into the business? Because I see it quite often where brother and sister, the brother might think, well, if sister dies, I definitely don't want her husband coming in and running my business for him. So it'd be useful to give a flavour to the guest of what you may think about in those scenarios, because that is something I think we see quite regularly, and I think it's quite often missed by other accountants as well.
Yeah. As you know, John, this is something you and I do very regularly with clients. And I think the important thing for anyone who's considering it to understand is it doesn't have to be overly complicated. It's just about following through a simple process of what if this happens, what would you like to happen? And then seeing if there's something that we can do to put in place that can help take that business in a certain direction. So if you use the example that you've put there, what we would be looking to do is ensure that in the event of somebody passing away, there is money there in the business to purchase those shares. So there are insurances in place that we can help clients with that will allow ensure there is plenty of money there. But we go a step further than that. It's all right having the money in the business, but you need to have a legal document that basically says, if I want to buy, you have to sell, or if you want to sell, I have to buy. And we call that a cross option agreement. So we take clients through that full journey and ensure that, in a worst case scenario, your business can continue and you can purchase those shares, because the surviving spouse in that instance, or it could be children or whoever, they're going to have a legal right to half of that business, and that can cripple a company at what is already a really horrible time. So it's about going through that process and understanding from a high level overview, what do you want to happen, and then making sure the building blocks are in place to ensure that happens.
Yeah, thanks, Matt. Kev, from your benefit, just interesting to see, I think I probably know the answer to this, but do enough people actually think about that type of planning?
No. I think people insure their mortgage, they insure their car, their holiday, their phone, their pet. But their business is funding their lifestyle. It's funding their retirement lifestyle. It may be funding their kids' school fees. It's going to fund a lot of things. And so, as Matt's just alluded to, if one of the shareholders were to die, that can bring the whole house of cards tumbling down. So you do get some clients who definitely see the need for it, and they probably go the other extreme and over insure. We've got some clients who don't see the value or don't see the need because it happens to somebody else, and clients say it's a waste of money, and I sort of try to say to them, well, yeah, it hopefully is a waste of money, because you're going to pay £100 a month to insure yourself for 20 years, because the other option is that you've passed away. So you hope that it's there as a safety net to safeguard your assets and your whole lifestyle of your nearest and dearest. So it is something Ryan and I talk to each other about for clients on a regular basis, and people are a bit put off by the potential cost, but unless you've got serious health conditions or something, it generally is a lot more affordable than what they expect.
Yeah. So, thanks for that, Kev. Just for Steve, I've got a really interesting question from Stephen Callahan and from Julie Belcher as well. Two really fantastic questions that will coming on the subjects we're going to talk about. So, Steve and Julie, we will be covering those questions off in a minute, but both really, really fantastic questions. So, thanks for those. So, kind of where we are now is we've got this client. They're going on their journey, so they've grown, they've developed, they've now got to the point where they're thinking about what their options might be. And quite a lot of times for our clients, we would do what we call an options paper. So we would look at them and we would go through all the pros, the cons of all different options. So what I wanted to do with Ryan, Matt and Kev's help is kind of take you through some of the options we see and not going into too much detail how they may work. And I think we can pick up Steve and Julie's questions as we go through them. So kind of the first one, I guess, Ryan, is, somebody comes to us and they go, right, somebody's knocked on my door, a big corporate or another larger local business, and they want to buy my business. So I guess sale is the first option really for those businesses.
Yeah, I mean, that's quite a nice position to be in when someone knock on your door. It tends not to be that way around. But I just note, Giles, there's a couple of questions in the chat as well, I think. So
yeah.
They're building up with that one as well, other than just the Q&A. But I mean, it's an ideal situation, I guess, if someone comes knocking on your door, particularly if you're ready for it. I suppose that's your stars are aligned, I guess, in that situation. So yeah, ultimately there's a conversation there. It's a bit of a negotiation piece. We want to sell, you want to buy, and it goes from there. It's no different to starting out. Certainly no different to buying a house or a car, I guess. There are different mechanisms that we can look at in terms of sale without going into too much detail. There's I'm using the company as an idea, as an example, but a company may sell its goodwill and its trade and its assets, I suppose. So the company still exists under the normal kind of structure with the normal ownership, but it would sell the good stuff out to that person that stood at the door, probably in their company that they've set up. There's a little bit of tax that goes with that in terms of the corporate existing company's going to pay a bit of corporate tax, and then we think about how we get that money out for the kind of exiting shareholder. What's a lot cleaner is that person stood at the door wants to buy the shares in your company, I guess. That's a lot cleaner in terms of in essence it's just the person at the door gives the person in the house a bag of cash, and in return the person gives back a share certificate, and they can walk away. So a sale is very much the sweet spot if that's out there. I'm finding though, Giles, that is whether it's markets, whether it's people just not being on the same page in terms of values, that is becoming less that real sort of third party transaction. It feels like for my clients there's fewer of them, just maybe because of the size, maybe because of it's owner managed, and they don't have that structure that the bigger corporates have. So I suppose I'm seeing probably fewer of those and more kind of your MBOs and your EOT type thing, which I'm sure we'll touch on. But is that a good enough?
Yeah. No, that's great. And Ryan, just for sort of everybody's benefit, because this will go across all discussion we're having, in terms of valuation, loads of different valuation methods we'll use, earnings per share, loads of different things. But high level overview, what's the methodology that we tend to use in a scenario for a sale, an EOT, an M management buyout, a family succession? Just give everybody a very high level how that might work.
Put me on the spot there. I like that. No, I mean, yeah, as you say, loads of different valuation methods. Net assets, dividend yield. Depending on what you're buying, cash flow basis. There's loads out there. Typically, the clients I'm involved with look at some sort of multiple of earnings. So I've got a good example. Hopefully we get onto that in terms of EOT and an MBO situation. And he's very much at the early stage of this kind of journey, if you like. But he's got his exit plan in place. And as such, I said to him, we can talk through how that mechanically might work, but ultimately for you, it's about increasing the value of this business and therefore essentially, make more profit. So the way that valuation works is it's geared on that, what we call maintainable earnings. So we look at maybe a 2 or 3 year period. We say, well, okay, good. The trend of profits is going up, which is fantastic. We would then apply kind of a multiple, an industry specific multiple that multiplies that up and gives you a theoretical kind of value for the trade, basically. It does assume that there's kind of like no debt, no cash type arrangement. So what you would then do once you've got the value of the trade, the trading element of it, you would make an adjustment. It's normal to see adjustments for things like if you've got a trading company, for example, that might have an investment property in it that is nothing to do with the trade, but clearly that's got value. So we then increase it up to what we call kind of would be like an equity value, if you like, an equity method. So in theory, you start with your kind of profit, you get that up to you multiply that up to something that's industry specific. That gives you the value of the trade. You then bolt on anything that's asset driven that isn't in the trade. You take off any, if it's highly leveraged, take off any kind of debt, if you like, and that gets you back to kind of an equity value. You split it between the shares, and that in theory gives you a price per share. High level.
No, that's really useful. And one thing I'd say, Ryan, is, I'm definitely seeing a lot more businesses come to me and say, I want to understand what my real value of my business is. Maybe just so if they succeed or somebody knocks on the door. So I'm definitely seeing that. Just, wanted to pick up on a couple of questions before we kind of kick off on the next option. An interesting question from Nikki Davis. So I have a business that no one wants to carry on, leave things to. What's my best option? Nikki, hopefully, if we don't achieve telling you that by the end of this, we haven't done our job properly. So bear with us. And by the end of this session, hopefully you should know. So that's a good one. And then a really interesting question from Jude Whitford as well for Matt and Kev. If you've already exited and sold, in the current climate, is it best to use the cash to pay off the mortgage or invest in pension? How long is a piece of string? Discuss.
Thanks, Jude.
I was going to say that there's lots of variables there, regards to your mortgage rate, any early sort of repayment penalties. You can only invest personally into pension if you've got the net relevant earnings to claim the tax relief. So it's not or definitely mortgage or definitely pension. It may be a bit of both depending on circumstance.
I think timescale's a big one as well, Kev, isn't it? How long is how long until you retire? How long is the mortgage got to run? There's loads and loads of variables with that. So it's not a straightforward answer to that one, Jude. Sorry.
Don't let them off, Giles, with that. They made me sweat on my question.
I think it is how long is a piece of string, Jude. I know you know me well, but there is no right or wrong answer there. It depends. Typical tax answer, I would say.
Can I just add something, Giles? Though, I'm not sure I'm making you sweat more, but presumably with the flexibility of pensions now, guys, that question must be raised a lot more than previously would have been. Is that a fair?
I think a big question that comes up, I'm sure, Kev, you see the same, is people asking, should I be taking money out of my pension to clear my mortgage, particularly now interest rates have increased and markets have been variant, let's say. So it's a really, really difficult one to answer, because for some people, I've got a client, in fact, I've had 2 clients in the last month that have done exactly that. And I would have argued that it was probably against my advice to do so in their circumstances. But for them, it was the peace of mind that I don't have to pay my mortgage anymore. So there is very much a human element to this as well, rather than just a figures thing, because, it's a no-brainer really to leave money invested for as long as you possibly can. That's how you're going to get the best returns. But for some people, it's the peace of mind. I haven't got to pay 500 quid a month for my mortgage anymore.
Yeah. So okay. Yeah, I've got a really interesting question in here for Bill Butcher, which I'll try and take, I think, and Ryan might take. Share transfer between directors. You mentioned having money in the business to buy shares. Could you explain the difference between directors' personal funds and funds in the business in the context? So there's lots of things here, Bill, and it's a complex discussion to talk about, sort of online on an hour session. But what you're looking at sometimes is we would do something called a company purchase of own shares. So say we've got one director within the business and his shares are valued at, say, £100,000. You can do something called a company purchase of own shares as long as the shares have been owned for more than 5 years. So the company can physically buy back those shares and pay that cash to the exiting director. We also can do what is called, we call it a new co on top, a restructure, where there is a restructure with a new company put in place. A very complex thing to discuss online, but a new company is put in place to actually exit a shareholder and for those shares to be bought out from the company cash. So hopefully that helps a bit, but Bill, happy to take that offline in more detail if needed. So Ryan, I thought we'd kind of go on to the next discussion, which comes on onto a question from Julie Belcher, which was one I held off earlier on. Is what are the benefits of exiting through an EOT? So explain what an EOT is, because we keep using this expression EOT, but a lot of people won't have a bloody clue what EOT is.
Yeah, well, it's okay. This is time to sweat again, I guess. I mean, EOT is essentially employee ownership trust. Often kind of referred to as the new kid on the block, I guess. It's not. It's been around for 10 years. Essentially, it might be easier, Giles, perhaps, if I look at an MBO briefly and then compare an MBO with EOT.
No, we'll come back to that. Yeah, no problem at all. Yeah, no, give us a summary of an MBO. So management buyout. So this is a business being bought by its management team.
Yeah, I mean, this is. I've got a client at the moment, which he is. The only reason I say that is because there are some similarities, and there are the advantages that come from an EOT. It's easy to compare them with the non-tax advantage scheme, if you like, or an MBO. So I think. With an MBO, I've got a case at the moment. It's a family business. It's run essentially by a group of siblings. It's owned by one of the siblings and his spouse. He's come to me and said, actually, I want out in 5-10 years. Look for a sale, which I think someone touched on earlier. Look for a sale. That's probably some interest there, but nothing that's come to fruition. He's now come back to me and said, actually, I've got a team in the office, a management team that I think could buy this business. Perhaps with me getting the profitability up and eventually stepping away from it, probably with maybe a little bit of external finance as well. But he's looked at an MBO. So an MBO is similar to what Giles said there a little bit in terms of company on top. There's a sale of shares from my client, if you like, to that company on top, which is owned by the management team. Normally, it's a bit of cash up front with a bit of deferred consideration in the form of probably with loan notes or preference shares, but an IOU essentially. The reason that's really attractive for people is that they can kind of get it ready and hand it over like a baton, hand it over really nicely and smoothly over a number of years. The downside for my client is he's making a disposal of shares, so therefore some capital gains tax to pay. The good news is he's probably going to qualify for business asset disposal relief in old money entrepreneurs relief, and therefore get a large chunk of it with his wife as well, so probably 2 million quid of it at 10%, providing rules don't change. Any residual will be at 20%, providing rules don't change. So it's one of those. He's quite poetic because he leaves it to the management team, but he's got a bit of tax to pay, but everybody's sort of happy. EOT comes rocking in again. Everyone thinks it's a new thing.
Ryan, do you mind me just sort of bringing something in? So I just wanted to clarify. So any person that exit their business will claim something called business asset disposal relief. It will be £1 million of lifetime gains tax, currently at 10% capital gains tax. Any capital gains tax transaction after that will be 20%. So where I come back to earlier, a lot more people kind of exiting earlier, because I think a lot of people are worried that 10 and 20% tax won't be there. One thing I wanted to kind of bring Matt and Kevin on as well is, when we look at, the management team of a business, so somebody succeeding that's within the management team, quite a lot of times we're looking, Matt, I think around, the kind of hierarchy of needs, I guess, around, what those sort of key staff in the business need and how we protect them and how we give them a warm feeling, I guess, because nowadays money, I think, pounds, shillings and pence isn't always the most critical thing. So I didn't know whether you were kind of wanted to touch on that, Max. I thought it was kind of a good time to bring that in.
Yeah, of course. So I mean, something that I was always training in this hierarchy of needs idea, which is essentially, I suppose you could view it like a pyramid or like a game of Jenga, I suppose might be a better analogy. But essentially, you got a client who's got a number one goal at the very top, which might be retiring at 60, say, as Kev's talked about before. And all the little jigsaw puzzle pieces or the blocks or whatever, they make up what that journey looks like. So it might be things like pensions, it might be investing, it might be ensuring income is secured for long term. All these little bits and bobs that sort of make it up. Well, the very foundation level of that, for us anyway, is protection, as we call it, or insurance. So in other words, if something did go wrong, somebody fell seriously ill, worse, somebody passed away, or someone was unable to work, when you pull away that bottom layer, all those priorities go out the window, and you essentially can't fund anything to make these dreams come true, without sounding too cheesy. So I firmly believe, and I know Kev feels the same, is that in all the financial planning we do, this insurance piece is the single most important thing. And it's really important that we do have these conversations with clients, and clients look at themselves and say, well, in a worst case scenario, am I looked after? So we try and keep the client focused at the core of what we do. You can go a level deeper to that because everything does cost money and everybody's got a budget. So it's about ensuring, well, what's most important to you, Mr. Client? So, for example, if you've got somebody who's self-employed, say painter and decorator or a handyman or whatever, he's far more likely to fall off a ladder than he is to pass away. So protecting his income might be the number one priority. Whereas if you've got a company director whereby they do the high level overview bits, but actually if they were off work sick, their income will still be paid because the company's still generating profits, etc. It might be that life insurance for their kids is more important for them. So it's about making sure that whatever we do is bespoke and in line with whatever the client's objectives are. But I bring it all back to this picture of a game of Jenga. What do you want to happen? Well, what could go wrong against that? And how can we step in and help with that?
I think what you find, Matt, is a lot of people struggle to have difficult conversations around inheritance tax planning, death. So, I think that the conversation about risk management has to be much more prevalent. I have a lot of clients whereby the business is owned by shareholders but run by a managing director.
Yeah,
and
absolutely.
I always say to those clients, what if that person didn't come into work tomorrow? What impact does that have on the business, and how do you protect that? And the other bit that I see with these businesses is, as well, as I have a company and it has loads of valuable cash, they're in a high risk industry, say in food and drink, where there's high health and hygiene, rules, and you've got loads of cash, loads of assets. How are you actually protecting those assets? So if something went wrong and your insurance didn't cover that, how are you protecting those assets? So I'm seeing a lot of those businesses set up, holding companies to own the shares above the trading business, and those assets be sort of farmed up, hived up into those businesses. So it links across a load of things. But I think risk management is one of the poorest areas dealt with in both of our industries, really badly dealt with.
Yeah, you hit the nail on the head there. For me, what I want is my clients to come back to me at the end of their terms of insurance and say, what a waste of money that was. Unfortunately, statistically, that won't be the case. So what we never want to happen is somebody who comes back to us and says, why didn't you tell me? Why didn't you say we could have done this because so-and-so hasn't come into work, or, dad's not come home, or whatever it is. These are genuine fear that we have as advisors. So if we're not having that conversation, we're not covering ourselves. We're not doing right by our clients.
Yeah. And one of the thing that I thought I'd bring in before, Ryan, you go on to EOTs is, around motivating staff is, I see a lot of people where, especially in family business, they just can't emotionally get over the fact of their key management owning shares in the business. So a lot of our clients would look at what we would call a share employee sort of share option scheme. So what they do is they put a share option scheme in, so the shares are granted at a price, and they have a trigger point, and that trigger point is quite often exit or maintaining or getting to a certain profit. So they will say, if we exit within the next 10 years, you will get 10% of the shares. So we see a lot of people now putting those share options because those managing directors or senior leadership teams are so critical to the business. We have to sort of tie them in. So we're seeing a lot more of share option schemes, and that is a sort of becoming very prevalent in business. So apologies for that, guys, but sort of loads of different things going around in my head. But coming back to EOT then, Ryan, because I know we got sort of 17 minutes left, so we're going to try and crack through some of this.
Yeah, no worries. So I mean, an MBO, as I went through, normally you have a holding company on top, a little bit of debt or loan note left there in terms of the consideration, but ultimately it's the management team. So take that one step further within EOT, and this is what my client's looking at now. He's really comparing both of them because there is something quite poetic and fulfilling, I guess, leaving your company that you've built up to ultimately the employees. What happens in this situation is a very similar type structure in that rather than a holding company on top, it's an employee ownership trust. So the employee ownership trust gets set up, the shares in that trading company get sold to the EOT, and the EOT hold those shares on behalf of on benefit of the employees, or for the benefit of the employees. So that's the way it's set up. Again, similarly, there's some consideration that goes kind of up and out to the exiting shareholder, my client, on day one. But But normally there's tends to be a bit more of a lead time in terms of the rest of the consideration being paid, but that might not be no difference to an MBO. So a bit more complex, a bit more paperwork involved, but definitely gaining some traction, as I say, because it's a bit more fulfilling, I think, for those exiting shareholders. It makes it a bit more, actually, I've built something here that I'm going to pass the employees, a bit like a John Lewis type thing. The only thing I would say is it does come with someone's mentioned it there in terms of benefits. Other than that John Lewis feel, everybody's involved, there are some tax benefits, which I'm sure my client is factoring in his decision making. Rather than the tax charges, Giles, you mentioned old money entrepreneurs relief that my client would face under the MBO structure. If he sold those shares and the EOT was qualifying, the trading company was qualifying, he would be exempt from capital gains tax, which would be potentially quite a big saving at 10 and 20% on the numbers we're talking about. So that makes it attractive. And there are some benefits for the employees going forward because they could benefit from tax-free payments during the years that in future. So there are some tax benefits. They're becoming more popular. They're almost discussed in a kind of hand in hand with MBOs, to be honest now, Giles.
Yeah, no, it's interesting. I have a lot of clients that don't want to sell to corporate, don't have family to succeed, so they like the benefit of the staff in the broader sense owning it. Coming back to Julie Belcher's question, what are the benefits of exiting through an EOT? Zero capital gains tax. One of the things we need to think about is at least 51% of the shares have to be sold to an EOT, so control has to change to the EOT. So that's one thing to bear in mind. And I think there is that lovely sort of emotional feeling about the staff owning the business, although it is really interesting that John Lewis over the last couple of years have talked massively about going into back into corporate structure, and that's mainly around debt funding. So mainly around actually how do we actually fund our business when it's loss making, because we're getting battered by the Lidls and the Audis of this world. So interesting to see how the feeling of emotion and looking after your staff goes out the window when things get tough. So interesting conversation. I have loads of discussions with clients about EOTs. Must admit, I've only delivered one myself. I know as a firm we've delivered loads, but only delivered one in the whole time of work. So interesting one. And then Ryan, I thought between us we kind of cover off what I call family. So that's family management buyout. So comes to a question that Steve O'Callaghan, sorry Steve, we made you wait all the way through. If you give your company to family children, does it get treated as if you were selling the company to a stranger? So, what do you want me to cover that off, Ryan, or do you want to cover that off?
I think if you do the family buyout piece, I suppose first off here, I mean the way Steve's used the phrase "give," so I always think that's a transfer of shares, Giles. So I suppose if you transfer shares to a family member or children, that's deemed to be connected, and as such you're absolutely right. For the default position is that needs to happen at market value, which you touched on there, selling the company to a stranger. So it's the same starting point. However, there are mechanisms behind the scenes that can essentially push that gain further down the family line, if you like, so that it only kicks in when the family members inheriting the shares or receiving the shares ultimately sell it their end. So it's a way of pushing that down. So there are some ways around it. So you are right in your comment there that yes, it is like treating it like a stranger. However, there are mechanisms that can kind of get around that and push that gain and tax on it down the line.
Yeah. So Steve, effectively what Ryan's saying there is if those shares are transferred to the children before death, we claim something called holdover relief. So the gain is held over and the gain is then taken by the children in the future. So that's what happens there. And if you kind of roll back 20, 30 years ago, most people would have transferred the shares to their children on death, because what happens there is those shares are enhanced to the market value at the date of death. So that has some advantages. But what we're seeing now is, and around the succession work I do is, I think it's very frustrating for children running a family business when their mum and dad or other family members are hanging around, and that becomes a very emotional subject around the dinner table. So we're tending to see a lot more clients do what I call a FAMBO, so a family management buyout. And that would be delivered in exactly the same way as Ryan's example of a management buyout. So a new company would be set up. That company would be owned by the family members that are going to succeed the business. So we're going to now own the business. And they would buy the business below for a value, say £5 million. I've got an example where I had two friends who ran a business, 4 children in the business. They sold the business to this new company in exchange for £6 million. £2 million was paid out of cash that's profits within the business maintained, and then £4 million was retained in what we call redeemable preference shares. And redeemable preference shares have the benefit that you get full inheritance tax relief. So those shares are not chargeable within the exiting generation's shareholding. So the benefits of a family succession are you get the new generation to come in with their new ideas, drive the business forward. The older generation that have exited, they get capital gains tax rates at 10 and 20%, like we've described, on the exit of those shares. But also there is that lovely succession of the business to the next generation where everything's moving forward, and you're effectively paying the exiting shareholders at future profits and some of the cash that's already retained there. So I think that is a really, really nice method to succeed a business, to get wealth to the exiting generation, but to bring the new generation through. So I don't know, Ryan, if there's anything that I kind of haven't covered there that you'd kind of like to cover.
No, I think there's a difference there, probably just in terms of giving shares with no consideration. You go, there you go, kids. You take it to the next level, and perhaps what you're talking about there is obviously a hybrid between kind of a sale to an external party, Giles, isn't it? But that party being your kids, so that's where the fanboy thing comes up. But yeah, spot on in terms of the structure. So,
yeah. One area that I thought I'd cover off, which isn't commonly seen, is what we call VC, so venture capital funding, or part venture capital funding. So when you talked, Ryan, about a sort of sale of the business in its purest sense, we quite often see venture capital funds or sort of other funds. So like the BGF fund, the Business Growth Fund, which was set up by the government, by the main sort of high street banks. And what their job is to take minority or majority stakes in business. So this might give, say you've got 2 shareholders, might give the opportunity of one of those shareholders to exit, but also funds to come into the business to allow that exit, but also allow growth. So we see quite a lot of funding by people like venture capitalists or BGF that come in, acquire minority or majority stakes, exit those shareholders, but give you an option to drive that business forward in the future. So that's kind of like a hybrid model of, a true out and out third party sale to a corporate or a large sort of local business. So I still see quite a lot of that as the options. So, if anybody's thinking about that, please feel free to contact us, because, we are seeing that, and we've got a lot of contacts in the venture capital space where our corporate finance team are working, but also within the BGF, those types of funds. And also there are funds like within Santander, there's the growth fund within Santander that does those types of exits. One other thing that I thought I'd cover off, because we've got 8 minutes, so we're doing pretty well for time. One thing I wanted to cover off is what I call sort of MVL, a members voluntary liquidation. So, comes probably a little bit to Nikki Davis's question. Hopefully we've covered off, Nikki, various options you've got, but what if none of those options are available? Ryan, do you want to kind of just at a very high level tell us what a kind of members voluntary liquidation does?
Yes. So again, these are and have been quite popular. It's kind of what do we say? It's end of life, Giles, and we end of life. There's no prospect of an external sale. There's limited prospect of an MBO or a FAMBO or any of those type of things. And you sat there and you think, well, I've got a company there that's got a load of cash in it and assets, could have some property, and you think, well, how am I going to get my hands on that as a shareholder? The value of that is. The 2 options that spring to mind, there is an MBL route. The other one, which a phrase I've coined for my father-in-law, is wither on the vine, which isn't very nice or sexy, but I think what he's trying to say there is turn it into a bit of a money box company. I think that's probably a bit nicer, where actually you just have a pot of cash, some investment property, whatever, that's generating some investment income, if you like, and then you get it out. What's it on the drip, I suppose. So you take that as dividends, but it very much depends on your level of dividend income or other income, depending on what tax rates you pay. So that could be a really attractive way of saying, well, actually, I've got no external third-party potential purchase there, but what I will do is I'll just keep it in the background ticking over, and I'll just drip feed the cash out to me really tax efficiently over a number of years. So that's kind of what I think he's getting at with wither on the vine. If you say, look, no thanks, I'd rather, live fast and die young, as it were, I'm going to MVL. I want to go into an MVL. That essentially is you appoint a licensed insolvency practitioner. They come along and say, we will take on this project where we will essentially put your company into liquidation. And what that does is it moves the assets of the company out of the company and through to its directors or shareholders, sorry. And on that basis, then there's normally a bit of tax to pay, but it can open the opportunity of you claiming business asset disposal relief, previously called entrepreneurs relief, depending on what assets it's transferring. But if it was a trading business, it built up some cash, it's still within that. There's a window there, and provided it's in that window, you can go into an MVL, and that cash can be distributed to the shareholders, less than fees, but you can benefit from business asset disposal relief. Then there's a question of what you do with the cash, but then that's where Matt and Kev come in terms of generating, income on that cash going forward. Is that high level?
So thinking about that, Matt and Kev, obviously somebody then comes, we haven't really talked about it, but somebody comes to you at the end of the cycle, liquidating the company, selling a company, and says, by the way, here we go, I've got £5 million of cash. What should I do with it? I guess that's a scenario that both of you see quite regularly.
Every day.
Yeah.
Well, again, that comes back to the sort of the financial plan we talked about at the start of this webinar. They've got a lump of cash. What's on their bucket list? How much they need in retirement to fund their lifestyle? What other income have they got? What other assets have they got? So we can build up that overall financial plan. So they can enjoy their retirement or whatever they do next.
Matt, have you got anything to add to that?
Not particularly. I think Kev explained it perfectly there. It's all about this cash flow model and looking at what are the short, medium, and long term plans. I think for anyone, the first thing we want to ascertain is what do you need in emergencies, what do you need for short term spending, and then what are your long term requirements. And using the cash flow model as we do, we're able to paint a very clear picture of what is achievable and what isn't.
Yeah, no, thanks, Matt. Yeah, coming back to the MVL, Ryan.
Yeah.
I know there's been lots of talk in the industry, and definitely the rules around MVL and Phoenix companies has become much more stringent, and we get lots of internal articles about, because previously it was very easy to wind up a company, start up the next day under, number 2 limited, and trade like that. But the rules are becoming tight, so it's always right to do this in the right way, and actually to get clearance, to get that capital gains tax treatment, we call it TIS clearance, is quite critical, isn't it?
Yeah, and I think it was popular with surgeons, wasn't it, at one point? They'd have limited companies trading through, and they build up a load of income, not take any out, and subject to income tax. What they then do is get it to a level, £200,000 or £300,000, as you say, liquidate the company, get the money out at entrepreneurs relief at that point, so 10%, then start up a new company, do exactly the same, and basically pay 10% on income. That they've closed, quite rightly, they've closed the door on that. So we do need to, and that's why I go back to end of life. This is very much is kind of this is you've got a company that's come to its end of its life, and you want to get that cash out. You've got no desire to go and do it again, or you should just keep the company there. The only thing I would say, Joel, just something that Matt and I have had on a case is where you've got to be a little bit careful if you've got a trading company or what has been a trading company and would benefit from things like inheritance tax protection or inheritance tax IHT protection because of its as you talked about previously, falling within the estate but not subject to IHT. If they liquidate and turn that into cash, that suddenly then forms part of the estate and therefore can be exposed to inheritance tax. But Matt, we've had a couple of cases where the outcome of that, I'm not quite sure what the outcome was and whether it's something you can go into now. I'm conscious of the time, but there are things that we can do afterwards. I believe there are things we can do afterwards to kind of put them in no worse position than they were by having the company.
Yeah, absolutely. Like you say, the time will be very, very quick. But yes, so we've got a couple of years, 2 or 3 years after when that sort of triggering happens, because you can go into certain products that qualify for business relief, essentially. So it's got to have been in that sort of environment for 2 years of the last 5 to qualify and be outside of your estate. So it's not something that clients have to panic about day one. But it's something that we do bring up and make sure that we don't go beyond that sort of date. Because it's just silly to lose 40% of that for being inside your estate when we could, move it over to something else, provided that's suitable.
Joined up, isn't it?
Absolutely. But these things do carry additional risks, so it's all about making sure that it's suitable for the client at the time.
Yeah, no, it's an interesting one, Matt. That I think that is an area that is massively missed again. So what I wanted to do, we kind of right at the end of the session, I think I've covered off every question that we've got. I just wanted to say a massive thank you to Ryan, to Matt, to Kev, to Saf and Lauren, who helped us put this session on. Hopefully we've given you a summary of kind of options for exiting your business, how you manage risk and how you protect assets. This is a moment when I feel like I wish I was a bit cooler like Kanye West, but I could do a big mic drop. But I wanted to say thank you for everybody that's joined. Hope you found it useful. We are here. Please pick up the phone. Please talk to us. We're always interested in meeting new people or our current clients just to have a general chat and see how we can help. So thank you, everyone, and see you on the other side.
Thanks all. Well done, Giles. Thanks, guys.